So I met with a couple last week, and the husband told me, I know, David, I am way too aggressive right now, and we need to get more conservative. You've heard that, right? Because you're approaching retirement, you've got to get much more conservative because you need to protect your nest eggs, your investments. And the reality is there is some truth to that, but using a blanket generalized advice is frankly not helpful because everybody has different assets, different income needs, different risk tolerance, different health, different lifestyles, different goals. And you have to take all of that into account when you understand how risky, should you be as an investor in retirement. Now, let's be clear. Some people don't want to be aggressive. That's okay. Absolutely. Invest based off of what you're comfortable with. But for those of you that actually enjoy being a little bit more aggressive, but maybe have been told, no, you need to be conservative, let's talk about it. You have one person who, let's say, has $2,500 a month coming from Social Security. They're not married, and they've got a pension of $4,000 per month. So they've got $6,500 coming in, guaranteed income for life. Their minimum dignity floor, which I've talked about in other videos, effectively their essential bills, cost about $4,000 a month. They spend close to, $1,000 a month on discretionary, going out to eat, enjoying their life. So it comes to about $5,000 per month. And they have guaranteed income of $6,500 a month before even touching their investments. That is person A. Person B is a married couple. The husband has $3,000 a month from Social Security. The wife has $1,500 a month from Social Security. So they have $4,500 a month, no pension. But how much income they need for their retirement is $8,000 per month. So couple B is down $3,500 a month that they need to take from their portfolio. And it takes roughly $250,000 for every $1,000 of income to create in retirement, right? If you take 250 in a 5% yield each year, let's say, it's about $12,500 per month divided by 12, it's $1,000 a month. I'm using very rough math. So these people actually need about $850,000 to generate the $3,500 per month. And they have $1 million. And person A has $1 million, but they're in very different positions, right? Person A has $6,500 a month guaranteed for life. They could never run out of it. They have $1 million in the market, and they only need $5,000 a month to spend to go out to eat for their everyday life. Heck, they almost have a paycheck coming in like as if they never stopped working. The sequence of return risk, it's almost non-existent for them as long as they keep living the same way that they do, right? They're not worried about running out of money. Person A can invest as aggressively as they want in retirement. They could invest as if they're still 20, 30, or 40. But person B, on the other hand, has $1 million. And the reality is they need to use $850,000 of it. It could be diversified across stocks and bonds and alternative strategies, however they want to create the income. But at the end of the day, it absolutely carries market risk. So when the markets do collapse, they need to be very strategic. Matter of fact, I would argue they need to be more conservative. What I would like to share and help you understand is being conservative in retirement, yes, is a good foundational philosophy because you do want to protect your nest egg, but it's not a necessity for everybody. So one thing I'd like to share with you today is your maximum drawdown tolerance, because it's so common. I meet people that are taking way too much risk and they don't recognize it. So the question is this: if you turn on Channel 9 News tomorrow morning and the market has completely crashed, to what extent are you comfortable seeing your portfolio drop? What is the absolute floor where you're no longer comfortable seeing it drop any further? So if you say $800,000, that would be a 20% drop. So your maximum drawdown tolerance would be 20%. But oftentimes when I meet with folks, especially before they're retired, we do a portfolio analysis and their maximum drawdown is 45%. They had no idea that if we go into a severe economy, almost half of their portfolio could be wiped out temporarily. And that part is very scary. I'll tell you a story. I had a client who had about $1 million with one of the big named firms. I'm not going to name it. And they were already in retirement. And their advisor had them, moderately invested. And so they thought they were moderately invested in retirement. But when the market collapsed, their $1 million went to about $545,000. And emotionally, they could not stand that, right? So what did they do? They took the assets out of the market. And when the market recovered, well, they also missed a lot of that recovery as well. And it, frankly, absolutely disrupted their retirement dramatically. And so when I sat down with them, I walked them through the same, line of questioning. What would have been your maximum floor that you were comfortable with? We say moderately invested, but let's quantify that. And they told me 20%. That's a very common average that I hear, 20 to 25%. So they're comfortable with 20, but they were taking on more than 40. They were taking on twice as much risk that they were, comfortable with, and they had no idea. And it's very, very unfortunate. So the encouragement that I have for you today is think about that question. If you were to wake up tomorrow and the economy was collapsed, what is your maximum drawdown? Is it 30%? Is it 40%? Is it 25%? That's the first thing I want you to understand and get comfortable with. The next piece, which would be helpful if you can talk to a financial planner who specializes in retirement, is understanding where the biggest risks for you are. Right? If the sequence of return risk, meaning the potential of running out of money in a severe market environment, is high, that is something we need to factor in. If that is not as big of a risk, it gives you more flexibility to be more aggressive. So the first thing you want to look at is, okay, what's my maximum risk tolerance to drawdown? Where are the biggest risks in my plan? You couple those two together, and now you can get an idea of, well, how conservative do you want to be, and how safe is it for you to be aggressive? Because at the end of the day, it is not about how much money you have. It's about how much money are you spending? What are your liabilities? What are your lifestyle? Right? What are your objectives in retirement? Is legacy important to you? Do you have longevity in your family or do you not? What does your health look like? How much guaranteed income do you have from pensions? How much guaranteed income do you have from Social Security? All of these things need to be factored in to understand, is it okay for you to be aggressive? And even if there is risk for you being aggressive, there are still plenty of safeguards that you can put in place. So when the economy is booming and it's strong, you're going to, benefit and participate in that fully. And when the market environment is severe and it's crashed, you still have a resilient plan in place and you have safeguards in place to protect your retirement.